Daniel Lacalle, thank you so much for joining us. Good to have you back on the show.
It's a great pleasure to be here. Thank you very much. Thanks for having me.
Now, Daniel, to begin, what do you think is behind the scare this morning fundamentally?
Well, what we have seen is a combination of much weaker economic figures than expected, perception of market participants that central banks would cut rates much faster than they're actually doing, and the level of excess taken on expectations of a big bounce on technology and on Asian markets after a correction that happened a week and a half ago. So those three elements basically have driven to sentiment going from prudent to fearsome, and at the same time level of unwinding of trades that were very, very aggressively indebted because of losses accumulated, and therefore creating the market slump that we have seen today. And that is why it has been particularly strong and particularly aggressive in Japan.
Speaking of Japan, how does Japan factor into the market plunge we're seeing here in the U.S.?
Well, you probably remember that the Bank of Japan has tried to maintain some level of support on the yen, which fell to 40-year lows recently, and has had to intervene at least once with aggressive measures. That means basically selling dollars and buying yens. You may also remember that the Bank of Japan has been one of the main buyers of ETFs, of equity traded funds in the Japanese stock market in the past years. By becoming the largest buyer of ETFs and at the same time having to intervene to support the yen, it has basically created an enormous tsunami in which the impact has been very aggressive and very immediate. The marginal buyer of those ETFs has disappeared, and therefore the slump has been much larger. And the initial measures to contain the yen have failed, and therefore that impact has generated a very significant backlash and very significant impact as well on other Asian markets and other economies in which the exposure of Japanese pension funds, and in which the exposure of those investors that are looking for an allegedly stable trade in the yen, have had to unwind very, very quickly.
And in terms of the U.S. market scare this morning, how much did Friday's job report have to do with it?
It was very significant because the Friday jobs report basically showed to the American investor and to the global investor that the concept of a soft landing, that the idea that the U.S. economy was going to be stronger for longer, that gains were very, very strong month on month, and that there was absolutely nothing that would drive the economy slower, basically broke last Friday. The jobs report was atrocious, and basically then a lot of investors thought, oh gosh, then a rate cut from the Federal Reserve is not going to be enough. And this is the big risk. No, the big risk is that the Federal Reserve may be behind the curve and may be behind the data and acting with data that basically talks about the past, the GDP figure, the jobs report of the previous month, etc., instead of the deterioration of the macroeconomic data. So I think that a lot of investors looked at the jobs report knowing that at best the Federal Reserve is going to make one rate cut in 2024, and thought, this is not going to be enough. This is not going to be enough. We need a lot more of Federal Reserve support in order to prevent a much more significant slowdown. And they basically also saw that the deterioration in the jobs market was very aggressive and very quick, coming from a jobs report in the previous month that looked at least in headline, quite positive, when it wasn't actually, because 1/3 basically came from government jobs.
Now, investors seem to be betting that the Federal Reserve will respond with more aggressive rate cuts. Now, Bloomberg's Marcus Ashworth is arguing that that would be a mistake. What should the Fed do now?
The Fed is caught between a rock and a hard place. If it doesn't act, the likelihood of the market reacting even more aggressively is significant. And this creates a relevant level of impact on commercial banks, on pension funds, etc. The market expectations of a no recession, no hard landing economy is one of the biggest, let's say, feeble arguments driving equities. No, so if the Fed doesn't act, then the market may continue to slump and generate ripple effects into the real economy. However, if the Federal Reserve decides to act because markets are weak and because there's a high volatility, but inflation remains persistent and the economic elements are not good but not bad, then it can create a worse policy mistake, which is to cut rates now, but then have to hike rates in the future. And that, as we remember from the past, can generate a much larger problem in markets and in the real economy.
Daniel Lacalle, thank you so much for your time.
Thank you so much. It's a pleasure.